What does the Fed's latest enforcement action mean for bank stocks and your portfolio? Today, we break down why a single compliance case can move funding costs, earnings, and valuations. The Federal Reserve announced an action involving a former employee tied to Bank of Eufaula and SNB bank shares. Details are limited, but the signal is clear. Supervisors are keeping governance and conduct risk in focus, even while markets debate rates and inflation. That matters because compliance lapses can ripple through a bank's balance sheet, change its cost of capital, and shift how investors price both equity and credit. The first insight is about individual accountability. Targeting a former employee shows the Fed wants responsibility to land with people, not just institutions. That raises the stakes for executives, risk officers, and lenders, and it can accelerate internal culture shifts towards stronger documentation and audit trails. Next, consider funding costs. When compliance risk rises, investors demand a higher risk premium. That can lift deposit betas, push up wholesale borrowing costs, and narrow net interest margins. Even small changes here can dent quarterly earnings and pressure return on equity. A third point is controls and remediation. When supervisors flag issues, banks often tighten lending processes, enhance monitoring, and sometimes pause certain activities. Resources move from growth to cleanup. That can slow loan originations, increase non-interest expense, and delay capital deployment like buybacks or dividends. The fourth insight is investor sensitivity. Markets now price regulatory risk faster. You see quicker dispersion across bank stocks and credit spreads as headlines hit. Names with clean control histories can trade at healthier multiples, while those facing actions may need time and proof of remediation to close the gap. Finally, think about the read-through to capital and reserves. If oversight findings point to underwriting or operational weaknesses, management may build loan loss reserves, revisit stress assumptions, and protect capital ratios. That can weigh on near-term profitability, but strengthen resilience. Here's your practical takeaway. Track enforcement actions and management's remediation plans on earnings calls. Watch for shifts in deposit costs, wholesale funding reliance, non-interest expense from remediation, loan growth pacing, and capital ratios like CET1. Compare valuation multiples to peers to judge whether risk is already priced. If you hold bank stocks or bonds, diversify across governance quality, not just size or geography, and favor institutions with strong internal audit, model risk, and third-party oversight. Want the full context and details? Read the full article at finlitica.com.